Hey everybody, we are going to get started. I'm Kenny Hawthorne. This is Ken Kennedy.
Ken Kennedy.
Ken and I have known each other since 1982, maybe.
Yeah.
We've done business together for all of those years in different ways, but we've never been in business together like we are right now. And so, in all of that time, we've been friends. But if you've been in business and associated that long, we don't agree about nearly anything. And so that's just kind of the nature of it. So we are with C2 Financial. We joined C2 Financial, was it November? When did that happen? Like just the end of last year?
September we made a move.
Yeah. Mm-hmm. So we made a move to a company that is a mortgage broker, largest mortgage broker in the U.S. So we're going to talk about reverse mortgages. So we have a plethora of resources. We were with Fairway, which means we had one lender. We were a lender, and we had somebody we could place a loan with. And now we have about 20. And on the forward side, we have about 100 lenders that we can work with. So we have a lot of resource that gives us options that other people commonly don't have, especially when you get into some of the out of the ordinary. If you get out of the ordinary, then we have a lot of really good options. So we're going to see if this clicker works. I think I have to hold it down for a while. Look, no? Well, that turned it off.
Well, while he's doing that, as Kenny said, we offer forward, reverse, all types of loans. We are retirement mortgage specialists is kind of how we hold ourselves out to be. And generally we work with seniors a lot, and seniors can get themselves into a lot of interesting loan and mortgage situations, as you know. So it doesn't necessarily always include the reverse mortgage. It could be a combination of different things that would involve something else. If you are, as I said,
I'm not sure.
All kinds of mortgages, anything you can think of.
I'm pushing
and probably
this
some
just
that you
up.
haven't thought of. It's very interesting. The broker world is entirely different in a lot of ways. So we'll get into a little bit more of that after the presentation. This particular presentation is about reverse mortgage, specifically the FHA's home equity conversion mortgage, or HECM for short. And we'll get into some of the options about that as we get into it. There are some things that are outside of the FHA's purview that are also inclusive. So we'll also enjoy your lunch, and then afterward we'll hang around. We'll be here as long as you want for questions and answers. If you want a little private huddle up for a scenario, we can do that as well. So just before we get really kicked off, who has heard of reverse mortgage? Okay, just about everybody. Has anybody had any experience with a reverse mortgage, either directly or somebody they know, or a real? One client, okay. One back there, okay. Excellent. So we can show you how this, in the presentation, it will include, things will start clicking for you about how this might be useful in your toolbox for a particular scenario with a particular client that has different needs. And so with that, you can take off.
This is a CE class. If you haven't signed up, Ken has a piece of paper that you need to sign so that you can get a 1 hour CE out of this if you want it.
Yeah, make sure if you want
the
CE.
So if you want that. And the course is about, it says reverse mortgage for purchase, and that's what we're going to talk to, but we're required to cover purchase and refinance, and most people want to know a little bit about both, and so we'll have to cover all of those. Some of this is really pertinent to purchases, and then some of it's like, okay, well, I'm sorry, I got to give you this anyway because that's just the nature of it, okay? And the requirements are, if you get up and walk out and never come back, Ken's going to make a note, and we're not going to give you any CE time for that. You need to sign that sheet, and if you have questions in the middle of this, I don't know how tight the time is on everybody. If you're in a bind to be out of here at 12 o'clock sharp, we don't want to hold you long, but we would, if you had questions and we could answer them, we would just answer them. If you have a question, I'd just assume you just ask it, and we'll see if we can answer it okay? So we start our classes. We've been giving this class all over the state of Texas. We've given it from El Paso to Houston, from Dallas to San Antonio. We ask this question, what color is the yield sign? So everybody, what color is the yield sign? Yellow. Is it
How many yellow? Raise hands.
yellow? Look something like that? Yeah? Are you sure? Any more? Yellow and black. Guess what? A yield sign changed. It changed from yellow and black to red and white in 1971. In 1971. Now, I've given this class, we've taught this class 50 times, I bet, and all over Texas. The biggest, where do you think the most argumentative group of Texans were who wanted to argue with me over this issue? Where? Yeah. No, it was in Bryan College Station. By the way, I'm a Longhorn. And so, yeah, it changed. And I challenge everybody across the state, go find me a sign that's yellow and shoot a picture of it and send it to me. 5 years, nobody's been able to do it. And so, what's the point of that is we have an idea about what a reverse mortgage is. We're pretty sure it's a yellow yield sign. But the problem is it's not, and it hasn't been for a fairly long time. But nobody knows, and so why don't you? And if you go online, you can find information, but you don't know how dated it is, and most of it's really pretty seriously dated. And so it's different than what it was. It's not what it was. It's not a loan of last resort. It's a sophisticated tool that financial advisors, and we work with a bunch of them, and we were on the phone with Lance Browning, who's in town here. He's one of our good financial advisors working on a deal for one of his clients because they see this as a tool. It's a tool that they can incorporate housing wealth into someone's retirement strategy. And so it's not about a loan of last resort, not anymore. It's just different than that. So what is it? Home equity conversion mortgage, I should put my computer over here, is a loan available to homeowners age 62 or older. You have to be at least 62, and they have equity in their house if they want to do a refinance. So equity in your home, typically, if you're going to do a refinance. All right? And so it's a limited liability, non-recourse loan. Ken, what does that mean?
Limited liability, in short, means that no one involved in the loan, the borrowers or their estate, family, kids, etc., are personally liable for repaying the loan. There's no personal debt transferred in any fashion with the reverse mortgage. The non-recourse refers to the fact that if the loan terms are maintained through the course of the loan, then the loan cannot be called due for any reason. So borrowers can live out their life in their home and not have to worry about what happens, okay?
So how many of you have ever been involved with somebody who had a HELOC, home equity line of credit, regular old home equity line of credit? You know, a HELOC can be called anytime they want to. I'm not sure if anybody's ever had that happen to you before. Did you know that was Wells Fargo late last year, decided they were going to call 100% of their HELOCs for all their clients to get out of the business. And they called them. And one day later, they uncalled them because the world went crazy. But a HELOC is like a lot of loans that is from a bank that they can make a decision that they don't like the balance of their portfolio, they don't like something, and they look at that portfolio and say, you know what, I think we're just going to get out of this business. And they can call that. It is not a non-recourse loan, but a reverse mortgage is. So it can never be called early. And what he said was a family member can never inherit debt. They cannot incur debt. They can't get debt out of it. They say it's not possible. And I have people ask me that all the time. I don't want to inherit debt. I don't want my children to inherit debt. They can't. It's not going to. Okay? Now we'll talk about how it exactly works, but they're not going to ever have debt to pay. All right, so here we are looking at an asset. This is an available asset. How would it work with a refinance? So a refinance. So somebody's got a house and they're going to refinance it. So a borrower can take available asset, they can take cash out of that house, they can take actual cash, they can close a house with cash, but it has to be with some limitations. They typically can take 60% of the available cash at the closing, and then they have to wait a year to take 40%. Well, why? Because the law changed and they don't want people to draw all their money out of that loan anymore. The other thing that changed, if you can see it right here, is the equity box is smaller than the cash box. You can't get as much money out of a reverse mortgage anymore. What people were able to get out of it 25 years ago is different than what you can get out of it today. And as a result, it's not as easy, or in many cases, it's nearly, I'm going to say, in a lot of cases, it's almost impossible for a borrower to live long enough to get upside down with it. They could. Everybody knows they could. It was a yellow yield sign. It's just not anymore. But people who took a reverse mortgage out 25 years ago, they were taking out 70% of the value of the house, 75% of the value of the house. And when you only left 25% equity, those boxes were switched 25 years ago, and you accrue that interest, you can get upside down. But the laws changed in 2012 and 2016. You can't get upside down anymore like you once could. It's not, I'm not saying it's not possible. I'm just saying it's really hard, and you have to live a long time. You have to start really early, and you have to keep it for many, many years. Most of the times when we run the amortization schedules up to age 99, at 99 it hasn't happened yet. Technically, a reverse mortgage is good to age 150 and then it renews.
150 and then it renews automatically, yeah. So
Okay.
if you live that long.
So if you can live to 110, 120, then it can happen.
And even if, in the strangest of circumstances, it does become upside down, there is a remedy for that built into the program so that the borrowers nor the estate are liable in that situation. Okay, and he'll explain that in a little bit.
So how do you get cash out of it? Well, when you take that cash, it turns into a loan. But notice the loan is, especially when you start, if you took 100% of the cash at closing or in the second year, you'd still have a loan that was less than the value of the house, and fairly significantly less. And as interest rates go up, the amount of money you can get gets less. So even today, it's a little less. It's still a good deal, but I mean, the interest rates go up. They call it the principal limit. Principal limit comes down, and so you get less money out of that loan. It still works, but it's designed today to make the FHA fund, the insurance fund, solvent, and to not let people get upside down. They want that house to pay off the note when the thing's done. They want there to be equity there to pay off the house. When that person dies at age 87, they don't want to be involved, and they want the house to pay off the note. That's the change. That's what made the difference. Borrowers can access their available resource as a term payment. What's a term payment? A term payment is when someone says, I'm going to take the equity out of my house and I'm going to pay myself $700 a month for 20 years. People will do that. They'll do it. Sometimes what happens is they take a term payment for 5 years. Why would somebody take a term payment for 5 years? Because they're taking a term payment from age 65 to age 70 so that they can delay taking their Social Security until age 70 so they can go ahead and retire. So they'll retire taking 5 years of their reverse, delay taking their Social Security so they can have full Social Security at age 70, but yet they can go ahead and retire. That's how financial advisors are utilizing reverse mortgages in their retirement, okay? So you can take a term payment. You can take something called a tenure payment. A tenure payment is taking the amount of money available from the reverse mortgage and say, I'm going to pay you for the rest of your life as long as you live. So the rest of your life, they'll take the money and they'll pay you. Now, obviously, they're planning on you dying, I want to say by age 94 or something like that, Ken, or
87.
That's what I said, 87. So they're planning on you dying, but if you outlive them, then you're going to keep getting the money for the rest of your life. We don't see hardly anyone just taking a term payment or taking a 10-year payment. It's just not what's happening in the market today. But what they are doing is they're setting up a line of credit, How many ever heard of a reverse mortgage and a line of credit? Anybody? A line of credit, we describe it this way. We think of it, we feel like people understand it when we say it's like a credit card that you haven't used. It's sitting there, it's available for you to draw on. The only thing is, it has a growth feature to it. It's a credit card that's going to every single month give you a higher available fund balance. You're going to have more money. And so we will see people, financial advisor will look at some of our clients, and we just did one in Houston. Well, they'll set up a line of credit as early in retirement as possible because they don't want to touch it. They have it sitting there, and what it's doing is just sitting there growing. And it's an emergency fund or a buffer fund. They're putting it in place as something that they can fall back on. They don't have to touch it. And that is an application that we see all over the place. Yes, sir.
Does that protect their assets by having a lien against it like that?
Remember, if you have a credit card that you haven't borrowed any money on, you haven't used it, you don't owe anything, you're not paying interest on money you didn't borrow. The guy that we did this for, my buddy in Houston, we just saw him the other day. So all of these guys are our friends now, but he did a line of credit. He took the closing cost of his reverse. I think his house was worth around $400,000. He borrowed the closing cost, which was about $20,000, and he put $170,000 in a line of credit. And his line of credit is growing at 0.5% more than the interest he's being charged. So let's just say he's paying 5% on $20,000 and growing 5% on 170.
5.5.
Just telling you. And it's just sitting there growing. And we saw him, we had lunch or breakfast with him just the other day, and he said, hey, it's just sitting there growing, and I just want it to grow as long as I can because I want it to be available in case I need it.
The reverse mortgage creates a lien, okay, on the home. All right. That when the last borrower, which he's going to detail here shortly, when the last remaining borrower is no longer permanently living in the home, the note becomes due. Then typically the home is sold, just like if you had a conventional note on it, a regular mortgage, you would sell the home, pay the note, the rest stays with the estate or the family. And he's going to detail that here. Does that answer your question?
Yeah.
Okay.
Yeah.
Okay.
But well, if you have
It is.
if you have two people, I mean, we're working with a client right now where one is probably going to remain in the home and one of them is going to go into some kind of a facility. But as long as one of them is living in the home, they can live in the home for the rest of their lives, and as long as it's their principal residence, and one of them can stay in there at least 6 months out of the year. So we'll have people that buy a house. I mean, they will buy a second home planning on living this and only 6 months out of the year. So that happens too. All right, so they get a line of credit. Line of credit has a guaranteed growth feature, 1.5% more than the prevailing interest rate. So what happens with the line of credit is it grows. It gets bigger. And we see a lot of people, I mean, that's one of the primary things we see happening today is seniors doing a reverse mortgage, putting money in a line of credit to make it available for their use. They don't always use it. They're not using it. We'll talk about what they can use for, but they're putting money in a place that they can get to it. Some people have money in a CD. They'll have $50,000 in a CD, earning nothing. Their financial advisors do not want $50,000 in a CD. But the person says, I got to put it someplace safe. I can't have it being risked in the marketplace. Well, let's put a reverse mortgage in place. We'll put $150,000 in a line of credit and let me put that money under management. And we see that happening. So this is how this stuff is happening today. What we would also see is someone doing a little bit of cash, a short-term term payment for 3 or 4 years to get them to Social Security and balance of it in a line of credit. Because you can do any combination of this stuff you want. And if you don't like the combination that you did, you can change it without penalty. You can change it anytime you want. You can change it as often as you want. So this combination of things becomes a powerful little tool. So this is what you do with the refinance. But what can a retiree do with the proceeds of a refinance? What can they do with it? they can implement what we call a coordinated withdrawal strategy. What that means is take some of the money from their reverse instead of taking it out of their portfolio. Did y'all know that a lot of people who are in retirement are dying today because they're taking monies out of their portfolio? And when they take it out, they're locking in losses. That's what happens when you take money out of a portfolio in a deeply down market. But those who have reverse mortgages are supplementing their income temporarily by not taking as much, so they're able to preserve their portfolios. That's what's happening with them. And they took, their financial advisor said, let's put this money in back so it can be available in case we need it. And that's exactly what's happening all over the place. So you can protect your portfolio with a reverse mortgage. You can pay the taxes of a Roth IRA conversion. I'm not going to get into all this, but I'm just saying what happens is a Roth IRA, guy's got $1 million in a Roth IRA and he converts it, he's got to pay $200,000 in taxes.
I mean, a regular IRA to a Roth.
Yeah, so what happens is, sorry y'all, you're gonna pay all these taxes. Well, the bad part is you're usually going to pay it out of your IRA. So now your $1 million IRA is now worth $800,000. You know what kind of growth you could have if you left that $1 million whole. You could leave it whole and leave it alone. You use the proceeds of your reverse mortgage to pay those taxes. Then the benefit of that is enormous by doing that. And again, that's what we're doing with financial advisors. You can fund long-term care for a spouse because that's a problem and it's a real problem. And people will do that. They'll use it for health care. They'll use it for those kinds of needs. What we don't see is anybody being stupid and foolish. We're not working with stupid, foolish people anymore. We're looking with people that are smart and they're utilizing this in a smart way. And I said they can delay taking Social Security. A lot of people want to retire. The number one reason you can't retire is because, what do you think the number one reason is people can't retire today? They got a mortgage. They got a mortgage, and that's a $1,000 mortgage on a fixed income. They're moving from an income to a fixed income, a lower fixed income. They have a mortgage. What does a reverse mortgage do? Gets rid of a mortgage. Don't have to make that payment anymore. So now they can delay taking Social Security. They can get rid of a mortgage. That's huge for them to be able to go ahead and retire when they weren't going to be able to before.
We talked about that.
That's the same thing. They can draw, that's called, we're talking about them protecting their portfolio. They can eliminate mortgage payments, which is huge. And did you know we see people do all kinds of interesting things with the proceeds of a reverse mortgage? Amazingly, we'll see this. Grandparents want to pay for their kids' education, and so they do a reverse mortgage so they can pay for their kids' college education, or stuff like that. Or there'll be a grandparent that just wants to be able to travel and go be with their grandkids. Grandparents will do anything to be with their grandkids. I mean, y'all know that, right? I'm a grandfather. I'll do anything to be with my grandkids. You can use it. Let me put it this way. Ken, what are the limitations on the use of the proceeds from a reverse mortgage?
Virtually nothing, okay? And the interesting thing about that is that the proceeds out of a reverse mortgage are tax-free. Let me say that again, tax-free, and we have verified that with irs.gov. So there you go.
There's no circumstance,
No
because we'll have somebody ask that question, do I ever have to pay taxes on these proceeds? And the answer is no, there's no circumstance where you have to pay taxes on them. You can also buy a home using a reverse mortgage. How many did you say somebody's done a purchase of a home with a reverse mortgage? Anybody? Nobody? Okay, you can buy a house using a reverse mortgage. So how would an available asset work for that? What would be the case? Well, we still have the same two buckets, right? The problem is that we have to establish equity. Remember, the equity bucket was really big before, but now we have to establish that equity bucket, and the reverse mortgage will be the difference. And so cash from the buyer. Well, when is anybody going to do that? Well, a lot of times it's when they were going to pay cash anyway. But in today's market, and you're doing a conventional mortgage, and you're doing it for somebody who's old, 67, 68 years old, what's going to be their problem? They're on a fixed income. What's going to happen with them? Their debt to income is going to be brutal. And how do you solve that? You solve it by making a larger down payment. So they get up, they were going to make a 20, and they don't want a mortgage payment anyway. So the first thing they're walking in saying, I have a house I sold and I want to buy another one. I'm going to right size and I'm going to get closer to my family. I'm going to get out of a 2-story house. I'm going to get out of the country and close to medical. I'm going to, whatever those motivations are. And they're saying, I'm going to pay cash for that house. I'm going to pay cash. And so do they have to pay cash? Because they don't want a mortgage payment because they're on a fixed income, right? That's what they don't want. So can you do it for less than 100% cash? Well, the answer is going to be yes. So let's talk about this guy. I mentioned him earlier. Here's my buddy from North Carolina, moving to League City, Texas. His wife told him that he was moving. That's what happened. That's what he told me. And so here's this guy. He's moving, and he's going to make League City his home, their primary residence, at least 6 months out of the year, because maybe he's not going to be there all the time. And David and Janina happen to be their first age, ages 75 and 71. This is the real counsel. And so he called us. And so in Texas, you got to be at least 62, which they qualify for. And they have to be, in Texas, you have to, if you're married, you both have to be on the note. I mean, you can't have a non-borrowing spouse on a reverse mortgage. So that's what they wanted to do it. And here's his situation financially. He had $1 million in his portfolio, and he was selling a house for $600,000. Does that sound like somebody who's looking for a loan of last resort? It's not. Y'all, that's not who we're doing business with anymore. So he said, I got $1 million, because I asked him, because we gathered this information, and he was a little over $1 million. How much you selling the house for? $600,000. Well, how much house you want to buy? I think it's going to be about $480,000, but I want to hold on to my $600,000. I don't want to give it all up. And my kids don't care about the house. I'm not worried about trying to hold on to the equity of my house for my children. They're grown, they're good, they're not looking for that. So I want to buy as much house as I can for as little cash as I can, and I don't want a house payment. Okay? So purchasing a house in League City for $480,000, his goal was to keep as much as possible. And what does it qualify? What qualifies someone? No delinquent federal taxes, a 24-month credit history, and some residual income. This guy happened to have, and this is just saying that this is an income statement. There's an income requirement for it. What is that like? Is that a VA like
no,
that?
It's FHA, and think VA limits $886 for a couple, residual income, and $529, I believe, for a single.
So the bar's pretty
income.
low, but you still have a bar for that. And they call it financial assessment examines their willingness and capacity. And so we're always looking at that. Willingness is about their credit payment history, their taxes, the stuff, the mortgage payment history, the rent payment history, things related to the house. That's what they care about the most. They're most difficult to explain away. And their capacity, and what's their income, what are their expenses, what's happening in their house. So they will assess that. And at the end of it all, if you're a couple, you got to have $886 left over at the end of the month. If you're a single, it was $560 or something like that. Not a high bar. In our world, people want Social Security 96% of the time qualify. They almost always do. Not every time, but they almost always do. So if they can meet that financial assessment, and David and Danina, this is really, I wrote this up, and I said, well, how much money do y'all get every month out of their pensions and out of their Social Security? It was $86,000 a year. So they were going to have more than $886 left over. And he still wanted to do a reverse mortgage because it's not a loan of last resort. Their children are grown and independent. They don't care. They wanted to manage their inheritance. They still plan on leaving them a legacy. They're going to manage the legacy. It's part of their strategy. It's not just something sitting over there that they're not thinking about. They incorporated it into their strategy, and they plan to give some to their kids. And I was saying earlier, DTI, debt to income, that's what usually gets them. You mitigate that by having a higher down payment. And when you get a higher down payment, suddenly you're getting closer to the payment required to do the reverse mortgage. So A monthly payment can decimate a retiree's fixed monthly income. The other thing you want to get is, why not do a conventional mortgage? I'm in the conventional mortgage business. I want to do them for you. I promise you, we'll do them. We'll do them all day long. But what happens with a 70-year-old who does a conventional mortgage? What's going to happen with what happens to their payment? How is that accrued to the bank? Do you remember? Interest. It is front-loaded. It is heavily front-loaded. Today, 75-80% of the payment they make is front-loaded. Now, what we're going to do is we're going to compare. Everybody wants to compare the cost of a reverse with the cost of a conventional. Reverse mortgage, you're going to have that 2% mortgage insurance premium. That makes the cost high. So now I've got a loan, and it's going to cost me $15,000 in closing costs, and I got a conventional that's only $6,000. So a conventional is cheaper. I should do a conventional. And okay, but I have a $1,300 payment, and in that next 10 years, I'm going to make $130,000. I'm going to make $132,000 a year. 13, whatever it is. My math was $132,000 at the end of it, of which 70-80% of that, I'm going to have $110,000 in interest. I'm going to give the bank another $100,000 on top of my $6,000. How much are going to give them on the reverse? I'll give them anything out of my cash flow. This is cash flow. Cash flow is king in a senior citizen's world. It's everything. Why? What if I don't have as much equity? Oh, no, you'd be surprised. When I did the reverse, it cost me a little more up front, so I paid a little more to make that down payment. I don't have payments at the end of that same time period. I've gained almost no equity. I spent $132,000, and I might have gained $30,000 in equity, and suddenly at the end of that same 10 years, my equity position is very similar. It's usually a little less on the reverse, but it's not that much less. But the cost is enormous. So when you think I can do a conventional cheaper than a reverse, I promise you that's wrong. All they got to do is look down the road. Look 5 years, look 3 to 5 years. You go 10 years, there's no comparison. You are out a lot of money on a conventional mortgage. And I love getting the money, but I'm just telling you that it's not doing them any good. Here's something that's pretty important that you want to get out of this on a conventional mortgage. With a person in retirement, income over time is uncertain. We don't know what's going to happen. Aging and health are uncertain when you're 65 and 70 years old. By the way, I'm 65 years old. Required to make a mortgage payment, requirements, that's uncertain. A conventional mortgage payment is always certain, and they're rude about it. They're absolutely mean if you miss them or have a problem with them. And so what we know is a reverse mortgage is certain. We never have to make a payment. Under any circumstance, we don't have to make a payment. And at the end of the day, what's going to pay that note off? The house is. The house is going to pay the note off. Heirs, family, never going to have to pay a dime. The house will pay it off. If the house can't pay it off, FHA is going to pay it off. So there's no risk for them. This is very real, actually. And so we deal with it so often, it's crazy. So what did he do? He had a down payment. If he did a conventional down payment on a $480,000 home, we were just guessing at half, $240,000. That left him with a $1,400 payment, 10 years, $172,000 in payment, interest over that time, $133,000. Contribution to equity, $39,000 out of $172,000. It's probably worse today because I think the interest rates were lower when I did this loan. You do it with a HECM, down payment was $295. It was more. It wasn't $240. No monthly payments, no payments in 10 years. Mortgage and interest premium was $163,000. Appreciation of the house was $4,000. Would there be anything left at the end of that same 10 years, and they kept the $172,000, they're going to have $373,000 if they die. That's what they would give to their kids. The idea that you don't have a legacy because of a reverse mortgage is simply not true. Okay? We run the math on it all day, I promise you. It works out today because you can't get in as much debt, and frankly, it's even less today than it was. Income is not pursued by a monthly mortgage payment. A mortgage payment is never required, and the borrowers can still manage their heirs' legacy. What time is it and how am I doing? Are y'all in trouble? Anybody? If you got to go, you got to go, but hang with us if you can. All right, other reasons buyers are able to purchase the home they want. We see people all the time. They sold a house for $300,000 and they go to they were out in the country and they come into town and say, I want to buy a house for $300,000, but I don't want to spend $300,000 because I want to hang on to some of my money. So what I want you to do is I want you to find me a house for $200,000, but I want it to be a $330,000 house. And old people are just rude about it most of the time, right? They're like, what's the matter with you young people? Don't you, I can't believe you're spending that much money for that house. There's no way I'd buy that house for that much money. Well, they're trying to hang on to some of their cash. But they can turn around and use a reverse mortgage to purchase that house. Or they can purchase more house. Instead of being the way we would describe it in the old days, they're on the wrong side of town. Instead of being in a place they don't want to be, go to the place they want to be and then let them spend less money for that house. They can buy the house they want and not have a house payment. They can still do it, okay? Senior clients can buy, what can they buy? Single family home, they can buy a condominium. Tyler's probably got those now. A townhome, duplex, triplex, fourplex, as long as they're living in one of those units, they can buy those. Or an FHA approved manufactured home. They can do any of those. And we see them all the time. One of the first loans we did was a manufactured home. And they're able to shop for a home with a higher value so they can get in the market they want to be in. And still hang on to some of their money. But mostly they can buy the house they want. Okay? That's important. In terms of the available funds, in terms of what people are doing, there's $11 trillion in home equity. Why do you care? You care about these old people because there's two things happening. Either they have money and they're going to do a refinance, or they're selling a house and they have money they can buy another one with. And I promise you, if you can show them the house they want instead of the house they're settling for, you have a better chance of a sale. So what happens with a repayment? And when do you have to repay a reverse mortgage? When does it come due? Okay? When the last borrower passes away or leaves the house permanently, it comes due. So let me tell you this story. So I have a client in Longview that did a reverse mortgage. His name was Bobby and Louise. And so they were living in an assisted facility. But you know that everybody's not cut out for that. And they hated it. And so they called me and said, we want to buy a house. I said, Bobby, you're 76 years old. What are you buying a house for? He's a former pastor. He's a great guy. He said, we're not going to survive here. We want to be in our own home. Okay, so we worked with him. We helped him buy a house. And then 2 years later, his granddaughter called me and said, Papa died. I said, okay, so what's the story on Louise? He said, we're going to have to put her in a nursing home. I said, okay, well, she said, what do I have to do? Do I have to do something right this minute? I said, no, you don't. So here's the rule, first of all, is that you're going to put your grandma in a nursing home, right, or in a facility. She said, yeah. I said, well, guess what? They're supposed to live in that house a minimum of 6 months out of the year. So I have 6 months before I have to tell them I don't live there anymore. And then when I tell them, I have 6 months automatically to do something with the house, with 2 3-month extensions to be able to sell that house or to process it or do something with it. So you go take care of your grandpa. When you get ready to sell a house, you call me, or we'll get you with a realtor. You can do it. But you're not under the gun to do anything right that moment. You have time, especially under that circumstance where you had somebody alive. Now, they both die. You have 6 months plus 2 3-month extensions. You have a year to be able to sell the house and do something with it. If you sell the house, it's like any other mortgage. You know, this is an FHA mortgage. It's not like one. It is one. So if you have a house and you have $480,000 value of a house and a $250,000 loan, what do? Sell the house for $480,000, pay the $250,000, and keep the money. It's the same. It's no different than that. Reverse can be repaid through the sale of the property. You sell the house and do it that way. You can buy the house. What happens if you get upside down? We had a case where there was this It was actually a homestead. It was kind of out in the country, and a grandchild wanted that house because the kids didn't care about that house. They had to tend with the cows and the chickens, and they didn't want to have any part of it. But the grandchild thought, oh, it was just very nostalgia. They wanted to buy it. So it's, okay, well, what can they do? If the house is worth less than the loan amount, if it's worth less than the loan amount, then an heir can purchase the house for 95% of its appraised value, no matter what. So again, you're okay with the story. We had a guy in Houston call me and said, hey, I got this person who's got a reverse mortgage and we want to buy her house. Okay, buy her house. What do you need me for? He goes, well, the house is damaged and it's got a reverse mortgage on it. Okay, what happened? We got hit by a hurricane. All right, so you want to buy it? I mean, what's the story? Well, she moved out of it 2 years ago. Okay, she moved out of it 2 years ago. Well, it's a reverse mortgage, so she had insurance. FHA's on the line to deal with it. But they haven't done anything, well, because it's a hurricane and there are a lot of houses that nobody did anything. I said, well, if you can get the mortgage processor to agree, you can buy the house for 95% of its appraised value. He said, well, the loan on it's $280,000. And you can buy the house for 95% of its appraised value. But the house is damaged by the hurricane. It's probably not worth $50,000 now. And you can buy the house for 95% of its appraised value. So call the guy and say you want to buy the house for 95% of its appraised value. You're going to have an FHA certified appraisal, and you can buy it for 95% of its appraised value. And he did. Because you can buy it for 95% of its appraised value, no matter what the value of it is. That was damaged, so it's not like it was worth $280,000, but always. They have to be, it's usually an heir, it's an actual heir, but FHA didn't want that house. They were happy to get rid of it. Heirs can never inherit a personal debt. No liability. It's not possible for them to do it. FHA is on the line, always. Always, always, always. Okay? You pay off the house, the equity is yours. People do it all the time. You can purchase a home for 95% of its appraised value. What would we need if you wanted to know, I have a house, I want to know how much cash would it take for a 62-year-old to buy this house? What do I have to have? What do I have to have? I would like to have their names and their date of birth, their address, the estimated value of the home, and the balance of any existing mortgage liens. I'd like to have that. But what I have to have is the names and the date of birth of the borrowers and the value of the house they want to buy. Okay? We just need a little bit of information, and it takes us about 10 minutes to say, today, y'all remember always today, you got a $500,000 house, it's going to cost you about $310,000. We just give you a number, and they can say, okay, that's what it would take to do a reverse mortgage purchase. All right, we had that's enough. What time is it anyway? You got your watch there? 11:46. So Q&A, we usually do that. We say people have questions. They always have questions. So we skip some of the myths. We skip some of the stuff to try to get into this little scenario. What kind of question does that raise for you? Anybody have one? I'll throw the myth questions out so that you can have some of those for just a second. One of them is, if I do a reverse mortgage, the bank owns my house. No. It's an FHA loan. You have a home, you got a mortgage, you got a lien against the title, just like every other mortgage you ever had in your whole life. You do not lose the title to your home because you have a reverse mortgage. If I do a reverse mortgage, I'm automatically upside down. No, because you don't have to take all the money. You can set it in place and then take money as you want it. And if you did a term payment, that'd be over time. But in all cases, if you remember those houses up there, the box on the cash available and the box on the equity, that box is smaller because that's what changed in the law. You can't get as much money, so you don't get upside down as easily. Average, what do you call it? The appreciation value of a home in Texas across the state is 4%. It has been. I'm sure what it's doing right this second, but it's still not nothing, I can tell you that. Your houses are still appreciating in value, and so that plays into this, and it makes this a very powerful tool. I have a lady also in Houston, Texas. I had a video I was going to show if I could make it work, but I couldn't. That we did a reverse mortgage on. She was a widow. Her husband was a veteran, Vietnam War. He was fully disabled, and so and he acquired dementia. He became cognitively challenged, and in the last 10 years of their marriage, they were married 52 years, his cognitive skills diminished, and he was the one who managed all their finances. So their finances went to hell in a handbasket. And she was left, when it was done, with his medical bills and his mismanagement devastating them financially. And there she is, living on her income now. Not his and hers. Whole deal would have been a lot easier if it had been together when they did it, but they didn't. And so called financial advisor, a friend of ours in Waco, called and said, we want to know, can you help these people? Can you help her? Now, she is the most beautiful, gentle, gracious soul you ever talked to in your life. And so we wanted to help her and said, hey, we're going to see if we can fix it. So we go and do the math on it all, and it's tough. And she's got credit issues, and so those are tough. But we have options. We're with C2 Financial. We have multiple lenders that we can work with. And so we start floating this out to those guys and saying, hey, this is who we want to help. This is what we want to do, and this is how we're going to do it. And we also told her, if we have to come up with a bunch of cash, if Ken and I have to throw the money at it ourselves, we're going to help make this happen. So there's something called a life expectancy set aside. So we were able to do a reverse mortgage for her, eliminate her mortgage payment, and take the proceeds of her reverse mortgage and put them into a life expectancy set aside to pay her insurance and her property taxes for the rest of her life. Do y'all think that changed her life? It changed her life. That's the business we're in today. That's what we're doing for a living, and we're really, really excited to be able to do it. And if you have people that you see out there that you want to help in that way, we're all about it. We'll do it. Anything else, Ken?
Occasionally we'll get a question or a comment that says something like, well, you know, my Aunt Sally's neighbor's bridge partner had a reverse mortgage. She was foreclosed on, so reverse mortgages are bad.
Yeah.
Okay, well, let's dig in a little bit. What's going on here? Make a long story short, this lady didn't pay her taxes on her house. Well, what happens when you don't pay your taxes on your house? It gets foreclosed on, right? You know, in any situation, they want their taxes. And so when you hear these things about reverse mortgage that don't sound quite right, probably because the story isn't quite right, or there's a lot more to it. So in the case of reverse mortgage, there are a few things that are basic and required. As Kenny mentioned earlier, you have to maintain your property charges, okay? Homeowners insurance, homeowners association dues, property taxes, and you have to maintain the house in an FHA standard, which is pretty basic. Okay, you have to live in the home the majority of the year. Okay, you can come and go, but accumulatively the majority of the year. Now, true, there are no FHA police out there. Please don't record that. But it's likely, you know, generally speaking, half the year. What else do you have to do? You have to pay your
I think that's it.
Yeah.
I mean, you have to pay your property taxes and
Property
pay your
charges.
insurance.
Yeah.
Yeah.
And
And you know,
maintain
the unfortunate part is if you don't have a reverse mortgage, you don't have to do that. Y'all can just live in your house and not have to pay your property taxes, right? Because they act like it's a burden when you have a reverse mortgage to have to pay your property taxes. I don't want to tell you. You got to pay your property taxes. I don't know how you get out of it. You still have to do it. And you still have to pay your insurance.
But the beauty of a reverse mortgage, especially if you're paying off an existing mortgage, now you've got some cash flow extra. Now you've got some, maybe a line of credit that gives you more resources to more comfortably maintain those items. And those are some of the life-changing issues that we see every day. We use the phrase that it changes the course of a retirement, which could actually change a life, whether they have means or don't have means. it all works the same.
Let me finish the story of my guy in North Carolina. We'll finish with that. So
This is pretty cool.
the guy in North Carolina, David, he calls me up and says, all right, I have a reverse mortgage. I bought a $480,000 house. I got I think it was like $180,000 or $190,000 reverse mortgage, $190,000 that is drawing interest. He said, didn't you tell me that I can make a payment if I want to? I said, yes, I did. Didn't you tell me that if I make a payment, dollar for dollar, the payment I make goes into the line of credit? If I pay the loan down $1, the line of credit goes up $1. Isn't that what you told me? I said, it is what I told you. And didn't you tell me that if I draw money out of that line of credit, that it's tax-free? I said, yes, that's what I told you. He goes, and that there's no limitation on how much I can pay. I said, okay, yes, but I am going to verify all this because now you're making me, now I'm, okay, what are you fixing to do? He said, I'm fixing to make a $150,000 payment on my reverse mortgage because I want my balance of my loan to go down $150,000 and I want my line of credit to go up $150,000. I said, okay, let me make sure. So I called the lender because, now he's talking about real money. I said, okay, let me make sure about that. So I called him and he said, yeah, as long as you don't pay it off, you're good. I said, what about drawing money out of it tax-free? Is there any circumstance? And they said, well, yeah, you call a tax attorney. So I called a friend of mine, a tax attorney in Houston, and said, what do you think about this? And they said, well, I'm pretty sure that's right. Yeah, I'm real sorry, but pretty sure that's right. That isn't really the answer I'm looking for. Pretty sure doesn't really work. And he said, why don't you check it out, go to irs.gov, see if there's something on there. I go to irs.gov, I put in the question, are the proceeds of a reverse mortgage ever taxable? And there, in fact, the question was in there. And the answer was no, there is no circumstance, under any circumstance, that the proceeds of a reverse mortgage are ever taxable. I said, David, you can do it if you want to. What are you going to do? He goes, I'm going to put that in there. I think it's going to earn around $12,000 to $13,000 a year based on what I'm seeing right now. And I'm going to give $13,000 a year every year to my grandchildren. And that's his plan. And where can he put that? At that moment that he was doing that, y'all know what the market looked like? It was horrible and very unstable and very scary. And what is the status of a reverse mortgage? A guaranteed 0.5% more than the interest rate. What was happening to the interest rates? They were going up. Do you think he wanted them to go down? No. His loan now was around $35,000 while his line of credit was $200,000. He wanted the interest rates to go up because he's earning 0.5% more than whatever the interest rate is. That's what people are doing. It's just being smart. And it's pretty amazing, really. And he was in North Carolina. I wish I could have said it was a Texan doing that, but it wasn't. He was smart. It was pretty amazing. And so CT Financial is a 30-year company, largest mortgage broker in the nation. It's got a network that's incredible, and we have been thrilled to be there. And that's, kind of like great facilities and great people. It's good to work with good people. We didn't know it would be good. You never know, right? You never know if it's going to be good or not. You make a change, you're hoping for the best. It turned out to be really good. We will stay here, answer any questions anybody has. If you have anybody you want to talk about, we'll be happy to talk about that as well. We appreciate the time that we could be here.
If you want the
Thank you
CE
so much.
credit, make sure you sign up on